Welcome to Breaking News to Trading Moves.
It's good to be here. We have a really specific set of market movements to look at.
We do. And we're focused on a particular event in the healthcare space. And what's different this time is we often talk about deals getting done. The ink is barely dry.
Right, the big announcements.
Exactly. But today, we're looking at the opposite side of that coin, a deal that fell apart, or maybe more accurately, one that just never quite made it to the finish line.
That's a good way to put it.
The headline event here involves Merck and their potential acquisition of Revolution Medicines.
That's the one, and just so everyone can follow along on their terminals, we're talking about Merck, that's ticker MRK, and the target company, Revolution Medicines, which is RVMD.
Right, so the context here is that for a little while, the chatter was getting louder and louder. It really seemed like Merck was closing in on a deal to buy Revolution.
It did. It felt like a matter of when, not if.
It seemed to make a lot of sense strategically. But the news that broke changed that narrative completely. The latest is that Merck has walked away. The conversations are over.
The talks have stopped, yes. And the reason being cited is, I think, what makes this so important to analyze.
Okay, so why did it fall apart? It wasn't, a problem with the science or some kind of last-minute regulatory roadblock.
No, and that's the key. It wasn't a clinical trial failure. It wasn't the FDA stepping in, which, as you know, can often be the death knell for these big pharma mergers.
Absolutely.
The reporting is pretty clear on this. The talks cooled down for one specific reason: price.
So it just came down to money, a valuation gap.
Precisely. The two sides just couldn't agree on what Revolution Medicines was worth. So for now, the deal is off.
For now? You think there's a chance it could be revived?
Well, the reporting does leave the door ajar. It suggests, talks could restart down the road. Or maybe another suitor, a different bidder, could step in and take Merck's place. But as far as the market is concerned, for today, the deal is dead.
And that gets us to the actual mechanics of the market reaction. Because when a deal like this just evaporates, it sets off a pretty predictable mechanism. We need to talk about the M&A premium unwind.
Yes, this is a classic market phenomenon. And to really get it, you have to look at how the price got so high in the first place.
Okay, so let's walk through that.
When a company, let's use Revolution Medicines RVMD, when it becomes the subject of a buyout rumor, its stock starts to behave differently.
How so?
It sort of detaches from its own fundamentals. People stop trading it based on its current sales or its cash flow or its pipeline progress on a standalone basis.
Instead, they're trading on the rumor, on the chance the deal happens.
Exactly. The stock price starts to reflect the probability of the transaction closing. Investors are essentially betting on a payout.
Right, because the acquirer, in this case Merck, is expected to pay a big premium over the current market price.
Correct. That's what we call the deal premium. You get investors and specifically merger arbitrage specialists who come in and buy the stock.
The ARBs.
The ARBs. They see the stock at, say, $40, and they hear the rumor is Merck will pay $50. So they buy at $40, hoping to capture that $10 spread. All of that buying pressure is what inflates the stock price.
So like a speculative layer of value that gets built on top of the company's actual, intrinsic worth.
That's a perfect way to describe it. It's a layer of hope. But when the news breaks that Merck is walking away, that hope vanishes. The probability of that $50 payout suddenly drops to, near zero.
And the layer has to come off?
The layer has to come off. The traders who were only in it for the deal, they rush for the exits. The price has to fall back down to reflect the company's reality as a standalone entity again. And that whole process, that rapid deflation, that's the premium unwind.
It's a swift and often painful adjustment. And this whole situation, this decision by Merck, it brings us to what feel like the main theme for this whole analysis, which is valuation discipline.
That's the core concept, absolutely.
It can sound like a bit of a corporate buzzword, but in this specific instance, it had a very, very real impact on the market.
It really did. Valuation discipline is, at its heart, the buyer's ability to just say no. It's refusing to get caught up in the chase and overpay for an asset, even one you really want, just to get a deal done.
And that decision, Merck's choice to walk away, it creates this whole cascade of winners and losers. And it's not just about Merck and Revolution Medicines.
Not at all. The impact spreads out to their competitors, their peers, even the banks that were probably hoping to advise on the deal.
It's a chain reaction through the whole sector.
It is.
So let's start with the winners. And Maybe a little counterintuitively, the first winner on the list is the company that didn't spend billions of dollars. We're starting with Merck.
Yes, Merck, ticker MRK. You have to see walking away not as a failure, but as an active, strategic choice. The reporting frames this very explicitly as an active valuation discipline.
Why is that seen as such a win, though? I mean, usually the market celebrates the big, bold acquisition, the empire building.
Well, history is littered with cautionary tales, especially in pharma. Investors have seen large companies get desperate for growth and massively overpay for biotech assets.
And then they spend years trying to justify the price tag.
Exactly. They struggle to get a positive return on that investment. So when Merck walks away, it sends a powerful signal to its own shareholders. It says, we are being careful stewards of your capital.
They're protecting the balance sheet, being prudent.
They are. No, we have to be clear, there is a trade-off here. It's not a pure, unqualified win.
What's the other side of it?
While they save the money, which is good, the underlying pressure on Merck hasn't gone away. They have a very well-known, very public need to build out their drug pipeline for a post-Keytruda world.
Keytruda being their absolute monster of a blockbuster drug that will eventually face patent expiration and generic competition.
Correct. It's a massive revenue generator, but it won't last forever. They need new drugs to fill that looming revenue gap. By not buying Revolution Medicines, they haven't solved that problem.
So the search continues?
The search continues. They have to either find another deal or hope their own internal R&D labs produce some major wins. So yes, they get credit for discipline now, but the clock on that long-term growth problem is still ticking.
But for the moment, the market seems to prefer a company that waits for the right price rather than just buying something, anything, at a bad price.
Generally, yes. Patience is seen as a virtue.
Okay, so this discipline from Merck also seems to have an effect on its peers. You've got AbbVie down as a winner here, too.
AbbVie, ticker ABBV. Yes, and this is more about the broader sector sentiment.
A read-across effect.
Exactly. When a market leader, a bellwether like Merck, shows this kind of patience on price, it tends to lift the perception of the whole large-cap pharma group.
Explain that logic. How does Merck being disciplined help AbbVie?
Well, the thinking is, if Merck, with all its resources and its urgent need for pipeline, is still unwilling to overpay, then it's likely that other big pharma companies are taking a similarly disciplined approach.
It suggests the whole industry isn't in a state of panic, just throwing money at any biotech with a promising molecule.
It sets a tone of rationality, yes. In a market where a lot of these premium oncology assets are seen as, frankly, very expensive, seeing the giants protect their shareholder returns is viewed as a positive.
So investors look at AbbVie and think, okay, they're probably also being smart about their M&A strategy.
It just reinforces confidence in the capital management across the whole sector. AbbVie benefits from, you could call it, the halo effect of Merck's decision.
Okay, that makes sense. Let's move on to another group of winners, the direct competitors. And this is where we get into the specific science of the drugs themselves. We're talking about the RAS and KRAS inhibitor space.
Right, this is where the competitive landscape comes into play. Revolution Medicines' key assets are drug programs that target these RAS and KRAS proteins.
Which are very important targets in oncology.
Hugely important and very difficult to drug effectively. So if Merck had gone through with the acquisition, what would have happened?
Well, those Revolution programs would suddenly have the full weight of Merck behind them.
The full weight of a global commercial machine. I mean, Merck's sales and marketing infrastructure is one of the most powerful on the planet. They can take a promising drug and turn it into a global blockbuster.
It would put a ton of force behind the launch of those drugs.
We sometimes call it a pipeline supercharge. The moment a deal like that closes, Revolution's drugs would have become a much more immediate, much more formidable threat to every other company working in that same space.
But because the deal is off, that supercharge doesn't happen, at least not for now.
Correct. And that makes this a positive development, or at least a sigh of relief, for the existing players. Companies like Amgen and Bristol-Myers Squibb.
It's got the tickers for those.
Amgen is AMGN, and Bristol-Myers Squibb is BMY.
And why are they the specific ones who benefit here?
Because both of those companies have major assets and strategic interests in this exact therapeutic area. Amgen was a pioneer here. By Revolution Medicines remaining a smaller, independent company, Amgen and Bristol-Myers face less near-term competitive pressure.
They don't have to worry about going head-to-head with Merck's marketing budget just yet.
It dodges that immediate risk. The threat of a rival drug being propelled by Merck's enormous resources is, for now, off the table. It sort of maintains the competitive status quo.
It keeps the playing field a little more level for the time being.
It does. It removes the imminent threat of a mega cap player completely disrupting their share of the KRAS market.
Okay, there's another class of winners here, and this one is all about the flow of money. The category is next takeout speculation.
This is all about the rotation of capital. It's a very common pattern in the market.
What's the thinking here?
The thinking is, we know Merck is on the hunt for a deal. We know they have the cash and the strategic need for late-stage oncology assets. So if the Revolution Medicines deal fell through,
The money has to go somewhere else.
the money has to go somewhere else. They're still hungry. So investors immediately start asking, okay, if not Revolution, then who's next? This starts to lift what you could call the rumor-sensitive part of the biotech market.
The speculation just rotates from one potential target to another.
It does. And investors start looking for companies that fit a similar profile to Revolution Medicines.
And what does that profile look like?
You're looking for high-quality, typically U.S.-listed, oncology-focused drug developers. A couple of names that tend to pop up in this kind of conversation are Kura Oncology and Blueprint Medicines.
Okay, let's get those tickers.
Kura Oncology is Kura, and Blueprint Medicines is BPMC.
And why them specifically? What makes them the next logical guess?
Well, they tick a lot of the boxes. They're in that oncology space. They have promising assets, some in late-stage development, and they are of a size that would be a digestible acquisition for a big pharma player like Merck.
So a portion of the investors who were betting on the Revolution deal now start buying shares of Kura and Blueprint on the assumption that one of them could be next on Merck's shopping list.
It's purely speculative, of course, but that speculation is powerful enough to drive the price action. The capital that was chasing the RVMD deal now rotates into names like KURA and BPMC, and that buying pressure lifts their stock prices.
It's a perfect example of how that pool of speculative capital just moves around the sector, always looking for the next potential deal.
The demand for M&A exposure is always there. When one door closes, investors immediately start looking for the next open window.
All right, so we've covered the winners. Now we have to look at the other side of this. Let's talk about the losers. And, well, the most obvious place to start is the target that got left at the altar.
Revolution Medicines, ticker RVMD. This is the direct victim, if you will, of that premium unwind we talked about at the start.
The deal is off, the speculative layer comes off, and the stock price drops. It's pretty straightforward.
It is. The market just strips out that acquisition premium. Without the immediate prospect of a buyout from Merck, the company's valuation has to reset to a lower level based on its standalone prospects. It's the simple mechanical downside of a deal breaking.
But the pain isn't just confined to Revolution Medicines. You also pointed out a group you called sympathetic movers.
Yes, and this is an important concept. This refers to other companies that see their stocks fall in sympathy with the target, even though they had absolutely nothing to do with the actual news. Abivax is a good example here.
Abivax, what's the ticker?
ABVX.
So what's the connection? Why does Abivax get hurt?
Because Abivax and other companies like it represent a similar kind of investment thesis. A significant part of its market price is based on the expectation that it, too, might eventually be acquired.
There's a takeout path already baked into its stock price.
There's an implicit M&A premium in there. So when a big, high-profile deal like Merck-Revolution falls apart, it casts a shadow of doubt over that whole thesis.
It makes other potential deals seem less likely.
Right. Investors start to worry. They think, well, if Merck is balking at the price for Revolution, maybe other potential acquirers will get cold feet with other targets too. The perceived probability of buyouts across the sector goes down.
So Abivax stock drops, not because of anything Abivax did, but because the general mood music for buyouts just turned sour.
It's a spillover effect. The sentiment turns negative for any company that relies on that M&A narrative to help support its valuation.
And that leads us to an even broader category of losers. What you've labeled sentiment and momentum stocks. This sounds like it's about the general psychology of the market.
That's exactly what it is. We often describe this as risk appetite compression.
Okay, what does that mean in practice for a trader or an investor?
It means people become less willing to take chances. A deal break, this public, this high profile, it has a psychological impact on biotech investors. They become more cautious.
They move from speculating on what could happen to demanding proof of what is happening.
Perfectly said. They stop chasing the dream of a quick buyout and they start demanding, cleaner valuations, clearer timelines to profitability, tangible revenues, they become much less tolerant of high multiple stocks that are priced for perfection.
And which specific companies are most vulnerable to that kind of mood shift?
The high multiple, story-driven oncology biotechs. And this is where it gets a little complicated because we mentioned Blueprint Medicines as a potential winner earlier.
Right.
But Blueprint, ticker BPMC,
Uh,
also shows up on this list as a potential loser.
that feels contradictory. How can it be in both camps?
It highlights the duality of the market's reaction. It's being pushed and pulled by two different forces at the same time.
Okay, break that down.
On one hand, as a potential next target, it gets an inflow of speculative money from people betting Merck looks at them next. That's a positive force. But on the other hand, as a high multiple stock that relies on positive sentiment, it faces pressure from the broad, sector-wide reduction in risk appetite. That's a negative force.
So its final direction depends on which of those two forces wins out on any given day.
Exactly. It's caught in a tug-of-war. The company-specific speculation pulls up, while the general sector caution pushes it down.
Are there any other examples of companies hurt by this sentiment shift?
Iovance Biotherapeutics is another one, ticker IOVA. It's a company whose stock tends to trade heavily on sentiment, on news flow, on catalyst momentum. When the M&A mood sours and investors get more risk-averse, companies like Iovance are often among the first to see selling pressure because they're viewed as riskier assets.
Okay, that makes sense. We have one last group on the loser list, the intermediaries.
The banks, yes.
So this is about the financial institutions, the investment banks, that would have been advising on a deal of this size.
This is what you'd call a second-order effect. Investment banks, especially their M&A divisions, make their money from fees on closed transactions. A multi-billion-dollar deal like Merck acquiring Revolution Medicines would have generated enormous fees for the banks involved.
And when the deal dies, so do the fees.
The fees disappear. So you're looking at institutions that are typically very active in big healthcare M&A. Banks like Goldman Sachs, ticker GS, and JP Morgan Chase, JPM.
They're always on the league tables for these kinds of deals.
They are. Now, to be clear, one lost deal isn't going to make or break their quarter. They're huge, diversified businesses. But it does represent a reduction in what you could call the near-term fee excitement.
It's a tangible loss of a high-margin revenue opportunity.
It is. The advisory business thrives on deal volume and deal size. One less mega deal on the board means less revenue for that division. It's a simple, direct consequence.
It really is a comprehensive picture. It's incredible how one decision by one company not to buy another company creates such a complex web of reactions across the market.
It's a great illustration of just how interconnected all these different parts of the market really are. Nothing happens in a vacuum.
So if we were to sum it all up, the central dynamic here is pretty clear. You have a buyer, Merck, showing price discipline. That leads directly to a premium unwind for the seller, Revolution Medicines.
And at the same time, that single event triggers a rotation of speculative capital into other potential targets, while also causing a broader compression of risk appetite across the entire sector.
That seems to cover all the moving pieces from this event.
I believe it does.
Before we wrap up, I do have to state the mandatory disclaimer. This discussion is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Absolutely. It's for informational purposes only.